Good evening, everyone. Very happy to have you today for the NCOIL Life Insurance and Financial Planning Committee meeting. It's good to be in New Orleans once again, and it's good for us to be together. There's no need for a roll call today. As acting chairman, I will mark everyone present. Good afternoon, everyone. I am South Carolina State Representative Carl Anderson, and I will be chairing this meeting today. First, I'd like to ask for a motion to waive the quorum requirements.
Second.
Okay. It's been properly moved in second. All in favor say aye. Aye. Those who oppose the vote nay. The ayes have it, and so it's ordered. Then I'd like to ask for an approval with a motion and a second to approve the July 15th, 2022 committee meeting minutes. All right.
Second.
Got a motion and a second. All in favor signify by saying aye.
Aye.
Those who oppose the vote nay. The ayes have it, and so it's ordered. Discussion and consideration of NCOIL Paid Family Leave, PFL, Insurance Model Act. We'll start today with discussion and consideration of the NCOIL Paid Family Medical Leave Insurance Medical Act. We've been discussing this issue since our November meeting in 2021, and we are now ready for a vote. Are you ready?
Yes, sir.
Oh, I couldn't even hear y'all. So I wouldn't want y'all to be at a football game with me. Before that, I'll turn things over to the sponsor of the model, Senator Paul from Minnesota. And I'm from South Carolina, so we don't pronounce people's last name.
Okay. Otherwise, I was going to give you the test. Utke. But thank you, Mr. Chairman, and members and those present. I'm proud to sponsor this model act and very confident you will see versions of it being introduced in legislatures around the country this coming year, and including my home state of Minnesota, where we actually passed something like this last year out of our Senate, but that's as far as it got. So we got to come back and start over. So you can view the model on the website and on the app, and it also appears in our binders on page 87. Just to briefly summarize the model, it establishes paid family leave as a class of insurance and would authorize state insurance departments to receive and approve paid family leave policies in their states. The model authorizes insurers who are licensed to transact life insurance or disability insurance business in the state to issue policies covering paid family leave, and this would empower employers to be able to give paid family leave to their employees. The model is also very flexible in that it can be used in states that have mandatory paid family leave requirements for their employers, and it can be used in states that don't have any paid family leave requirement, but the employers want to offer it as an enhanced benefit to their employees as we see an ever-increasing competitive employment market. I look at this as an extra tool or an additional tool in the toolbox for the employers. It's a tool that can be used to retain or recruit new employees. We're seeing more and more what we have out there as far as a shortage in our labor market, and this may be one of the tools, if it fits your business model, that would be great for them. Also, the model is drafted in such a way that it can be adopted just as an authorization statute and then have as a regulation the standards that would go into that policy, or you can put the entirety of it into your statute when you propose it. Virginia went the authorization route, and they are now working on regulations as an example, and it's expected to be. And with that, Mr. Chairman, I think we have another testifier that would like to speak to this, but in the end, I would ask the committee to approve this Model Act. So thank you.
Thank you, Senator from Minnesota. With us here today is Ms. Kieran of the American Council of Life Insurers, who would like to say a few words in support of the model. Ms. Kieran, please go ahead.
Good afternoon, Mr. Chairman, and thank you very much. My name is Karen Melchert. I am a state director with the American Council of Life Insurers. I've been before you now 4 or 5 times with this proposal. Beginning back in March 2020 when we first brought it forward, I'm grateful for the support of Representative Ferguson and Senator Utke in sponsoring this. We do believe that this is a tool for states that have a mandatory paid family leave requirement and those that do not, who wish to expand the benefits they can offer their employees. And I would appreciate your support and a yes vote. Thank you.
Thank you, Ms. Kieran. I tell you what, after seeing you over the last 2 years, I know you're just as happy can be today. If I was back in South Carolina, I would tell you about your new hairdo that you have. You know, we notice things in South Carolina. But thank you very much for your kind words. Are there any questions from any legislators? Okay.
Thank you. Have you had any discussion with insurers to see if they're interested in this? Are they going to be able to come up with an actuarial analysis?
We actually have several companies that are preparing products to be filed in Virginia once the regulations are finalized. So they have been able to put that together, but that's a very good question. We've been working on this for several years. So they've been working on developing these products while we've been trying to get this off the ground and starting with Virginia. And then we have a handful of states that we have teed up for 2023. And once those are approved and the regulations are adopted, then we expect them to be filing policies at that time too. And they're already doing this in some degree in the states where there is a mandate where the state has outsourced it to other insurance companies to help run. So they've got experience out there for this product in particular, just not necessarily as an insurance product on its own, but operating this type of program in states where it's been mandated already, where there is
One follow-up. I'm curious about pricing. Have you seen any pricing models?
I have not seen any pricing models myself, but I can certainly get some of that information for you from the folks that are looking at that from an actuarial perspective. I'm told it's similar to a DI product.
And just one other one, if the employer has, say, a short-term disability policy, how does this interact with that?
This could be attached as a rider. It can't now because there's no authorization for it, but it could be included in your DI policy as an added-on benefit as a rider for an additional premium, but not a significant additional premium from what I'm told.
I'll say one of the things I like about this is it's an offering instead of a mandate. Instead of the government coming and say you have to do it, you're saying here's a tool if you want to do it. Thank you.
Thank you, Representative Dunnigan. Now we will hear from Representative Ferguson.
Thank you, Mr. Chair. I have more of a comment as a co-sponsor. Yeah, I think this is a great model bill. I was glad that Senator Utke, I can say his name, brought the model legislation. Not only is it a good private option insurance for states that have mandated family leave, but I'm from Arkansas. We don't have mandated family leave, and I did, checking with my insurance department, found that it will require some statutory change for us to allow this. And I look at it much like disability insurance, but in Arkansas, we will have to run a bill so that the insurance company can actually allow these companies to operate in the state. So you might check with your insurance commissioners and see if you need that. But as he pointed out, it has really become a very competitive employment market. You know, where people are looking for time off, they're looking for 401ks. I mean, to attract employees now, you look for more ways to empower that. And certainly in medical offices, you employ, you know, a lot of young women that, you know, have babies or have family they need to help take care of, those kind of things. So it's very attractive to me for those reasons.
Thank you, co-chair of the model, Representative Ferguson. Now we will hear from Representative Carter.
Thank you, Mr. Chair. My question is, does this legislation allow states the flexibility to opt out or modify the model if needed to fit their state's requirements?
It would. I think that's directed at me. I'm not sure. Do you want to, sorry.
Thank you. Yeah, we can both jump in but yes, it would, the flexibility remains at the state. You can, it's kind of set up, there's two options. One is to, introduce it. The other would be to go into, take it all at once, but it's whatever fits each state, and they get to take as much or as little as they would like to make this work for them.
Do we have any other questions?
How you doing? I don't know if you're familiar with the model we did in New Hampshire. We passed the legislation about a year ago. The state has state family medical leave for our employees, and businesses in the state can sign on and join that. Are you familiar with how we're doing that, and would this be better?
I didn't catch the first part. You've got the state mandated portion of it, right?
For state workers. Only for state workers, we give them paid family leave.
Right.
And then businesses in the state can join on to that program.
The states could, or the employers could buy into that. Well, in this case, the employer can buy this as an insurance policy, and I think what I've seen in some of the mandated states too is you come down to a certain level and the small employers are maybe exempted. And if you happen to be one of those small employers that this was that piece that you needed to recruit the employees that you're after, in the private sector, you could go out and purchase this. There's other employers that none of this works for them. I mean, just to the nature of their business, you're a small employer, you only have a few employees, you can't afford your employees to actually take off 3 or 6 months as much as you want to help them out. So the flexibility is in the employer's hands, which is great. They can use it however it best fits their business model.
Thank you.
I want to thank the senator from New Hampshire, and did he answer your question?
He did. I've been enjoying your opinions.
All right, man. Save me one. Representative Ferguson?
Yeah, I want to say actually, there are several models of this. Obviously, there's states like mine where it would just be up to the employers to buy it. There are states where it's mandated and they do it with private insurance, but really New Hampshire is a great model because you're empowering private companies to be included in your plan, which makes it more affordable for them. So I really think, I hope that's something that we'll look at in Arkansas.
All right, certainly want to thank everybody for their questions, and I'm sure that the sponsor would like to offer a motion at this time.
Thank you, Mr. Chair. Yes, I would like to move that this model act be adopted.
We have a motion by Senator Paul. Second by Representative Jonathan. All in favor, say aye. Aye. Those who oppose the vote nay. The ayes have it, and so it's ordered. Man, y'all make me feel like getting up dancing here now. Dealing with this thing for 2 years. All right, thank y'all very much. Our next topic is a discussion on uniform regulations of insurers investing. Just some quick background on this topic before we begin. We had a session on private equity's influence and impact on the insurance marketplace in July, which generated discussion on whether or not there should be increased regulatory scrutiny of private equity-owned insurers. This session today is meant to continue that discussion and bridge the gap by offering information as to why such scrutiny should be based on the activities and investments of the insurers and not ownership structure. And so, joining us today, and I invite them to come and sit at the table where the panels will sit, and hopefully make sure you got the right name tag, will be Michael Parcella, Senior Director of AM Best Rating Services. And the second person is one whom I have known for many years and who has served the nation state of South Carolina, a friend and a brother, Governor Jim Hodges, former governor of South Carolina and now Executive Director of the National Alliance of Life Companies. And ladies and gentlemen, back in South Carolina, when the governor or anybody of that official comes in, we ask everyone to stand. So rather than y'all standing, I'm going to just ask you to wave your hands. And good to see you, Governor Hodges. And then we have Ms. Jennifer Webb, Assistant General Counsel and Head of State Government Affairs at Pacific Life. And we'll hold all our questions until the end. Go ahead, Mr. Michael, it's all yours.
Is it live?
Pull it closer to you. No.
Oh, sorry about that. And I wanted to see if we had our slides up there. We don't. So thank you, Chairman Anderson, for the opportunity of speaking in front of you. I want to let you know that I had some slides prepared, but I can give you, oh, there we go. Okay, so many of you are probably not aware of AM Best. We're a rating agency. We rate insurance companies. It's really all we do, and I just lost my slide. Let's see if we can. Okay, we were established in 1899. This is going to take longer if it keeps coming up like this, but why don't I just go and give you a sense of what AM Best does. We rate insurance companies. We've been doing it for almost 125 years. We are exclusively a rating agency for the purpose of rating life and property and casualty insurers. We rate companies from the United States, all around the globe, onshore, offshore. We have 135 rating analysts located in 5 different offices. We rate 3,300 insurance companies worldwide. We also do research, publications, and the like. We became a nationally recognized statistical rating organization in, I believe it was 2007, so right before the financial crisis. And so how do we rate insurance companies? Well, we have a criteria that we use, and I want to show you it's a building block approach. Come on. Okay, well, when we rate insurance companies, what we publish is something called an issuer credit rating and also a financial strength rating. Basically, in rating committee, we vote on an issuer credit rating and then map to a financial strength rating. Financial strength ratings, I think, are what people are traditionally associated with AM Best. They're actually a bit more granular, and so we have a mapping for that. We also rate debt of insurance companies. So what we don't rate is CLOs and sorry about that. There we go. Okay, so here's our building blocks. And the foundation of the building blocks is actually the balance sheet strength. So the first thing we do is we assess the balance sheet of a company. We then make adjustments up or downwards for their operating performance, up or downwards for their business profile, and then up or downwards for their risk management practices. And then what we ultimately wind up with is that issuer credit rating that I was talking about. The highest you can get on balance sheet strength is an A+, and then the movements up and down can get you all the way up to a AAA. There are some companies that are AAA in our portfolio. New companies, the kind of companies that we're talking about here, are actually limited on their balance sheet strength to an A. Forgive me for getting very technical on all this. And what's the basis for that? It's going to be the projections that they provide for us. And our management meeting that we have with the company. And here's an overview of what it looks like from the point of view of the building blocks and some of the components in here. And the main thing that you're going to notice is that we don't actually include the form of ownership. So if you are a mutual, a fraternal, a stock company, whatever it may be, if you're owned by private equity, you're not going to see anything here that that goes and penalizes you or rewards you for your ownership structure. But what is important to know is that there are certain things that come along in our analysis that are driven by your ownership structure. For example, I don't think it's a secret, companies that we've been labeling private equity insurers, they've typically have more asset risk. So they usually have some sort of expertise in certain asset classes. So what does AM Best do to get themselves familiar with it? And the answer is, well, we have a capital model, and we apply capital charges. So we have a published BCAR score that we use. We also have an investment working group. So we've had many companies come to us and say, you know, we've got this asset class. We believe that we can achieve superior returns. What we have to do is we have to take that asset class and put it in front of our investment working group. And the reason for that is to make sure that we're applying the proper capital charges. There are a few other things that you're going to see with private equity firms. There could be a reliance on reinsurance. There could be different financial flexibility based on the level of commitment from the parent, right? So those are all components of how we rate companies. But ultimately, I think one of the things that we really have to get our arms around is the fact that the time horizons for the capital involved in insurance, life insurance and annuity insurance, is longer than what is traditionally associated with private equity. Private equity firms tend to look at 3 to 5 year types of time horizons. And everyone in this room knows that the life insurance business and the annuity business is not a 3 to 5 year business. So my concluding remark is one that I share a lot, and that is that I don't believe that there are any barriers to actually enter the life and annuity insurance business. It's actually fairly simple to do. If you can go and raise some capital, come to us, get a rating, put together a management team, you can be in the insurance business. It's not the barriers to entry that matter, it's actually the barriers to exit. Because getting out of the insurance business is actually much harder to do, given the long-term nature of the liabilities. So with that, I think I'm going to pass it on to my two panelists here.
Governor Hodges. Oh, he's yielding to her. Okay, go ahead.
She can go ahead, and I'll go next.
Go ahead. Ms. Jennifer.
Thanks. Good afternoon, Chair Anderson and members of the committee. My name is Jen Webb, and I represent Pacific Life Insurance. Also, happy to be here before I start my remarks. I'm a former NCOIL staffer, so it's always fun to be on the other side of the dais. And I'm a Tulane grad, so it's always fun to be back in New Orleans. And I hope everyone gets some time to enjoy the city. With that, I'll actually talk about what I'm here to talk about today. So I plan to take the next several minutes to provide a high-level overview of regulation of the life insurer investing, and to note a key NAIC workstream that Pacific Life and several other companies believe is particularly important. So state policymakers are charged with safeguarding the ability of insurance companies to keep their promises to policyholders by ensuring their financial health. One of the tools that regulators use to measure financial health of a company is risk-based capital, called RBC for short. The RBC requirement is a statutory minimum level of capital that's based on two factors. One, the insurance company's size, and two, the risk profile of its financial assets and operations. In other words, the company must hold capital in proportion to its risk. The purpose of the RBC requirement is to identify weakly capitalized companies before there's a problem. It's in effect an early warning system, so think like a check engine light. So for my remarks today, I want to focus on the second factor of the RBC calculation, the risk profile of a company's financial assets, and how regulators determine RBC charges. Generally speaking, state regulators use an activities-based approach to determine RBC. That's to say, they look at the types of financial instruments that insurers are investing in and the types of products that insurers offer to look at the risk level. Given that there's more private equity-backed companies that are entering or have entered the life insurance space, it was previously discussed, it was noted earlier at the July meeting, that ownership structure was coming under scrutiny in relationship to riskiness. While there has certainly been attention paid by policymakers to the growing presence of private equity firms in the life insurance space, this is not, in my opinion, the current focus at the NAIC, because RBC calculations apply to all companies, no matter their ownership structure. So what is being discussed around RBC calculations currently? Last year, the NIC took an important first step and updating the Life RBC framework with the adoption of revised capital factors for bond investments. These changes introduced a more granular RBC charges for bonds by expanding the number of NAIC designations from 6 to 20, similar to the rating scales that the rating agencies use. This was always acknowledged by the NAIC and the industry to be the first phase of a longer-term initiative exploring the differentiation of RBC treatment across diverse asset risks. The NAIC has chosen to begin the next phase of this project with a focus on asset-backed securities, or ABS. Generally speaking, ABS is kind of like a mortgage-backed security, except the underlying assets are something other than mortgages. The NAIC is currently focusing on CLOs, or collateralized loan obligations, which are a type of ABS, generally composed of highly leveraged corporate loans. The timing of this work is important because insurers have become the biggest U.S. investors in the CLO market, topping banks, pension plans, and hedge funds. In fact, insurers currently hold 60% of all single-A and triple-B rated CLOs, which are riskier than the AAA and AA holdings. And certain firms tend to hold higher concentration of CLOs with this credit quality on their books. The NAIC has taken note of these developments and has developed a high-priority work stream around CLOs and RBC charges. While RBC is intended to be a blunt instrument, at the same time, it is critical that any capital charges are appropriately calibrated across different types of asset classes to accurately reflect risk. If the capital charges don't match the risk for an asset, this could be problematic from a financial solvency perspective. Currently, for RBC, CLO is treated the same as corporate bonds, but they do not share the same risk characteristics. To be clear, CLOs are not bad. Pacific Life invests in them. If used well, they provide insurers with high-quality options to tailor cash flows for different investor return needs. However, CLOs come with long-term risk sensitivities that are not well captured in the current RBC framework. Simply put, CLOs are not the same as a corporate bond. And CLOs do not perform the same in stress as corporate bonds. In a stress test performed by the NIC SVO office, these assets are shown to suffer losses that are not consistent with corporate bonds, again, potentially posing solvency risks. This is why the NIC is working to model CLOs similar to the process they currently use for mortgage-backed securities to make sure the RBC charges are appropriate. Pacific Life supports the NIC work and is working with a diverse group of companies who are aligned to modernize the RBC framework. This group includes Equitable, New York Life, Northwestern Mutual, and Western and Southern, among others. ACLI has also expressed support for this project. Finally, I'd like to briefly note that beyond the CLO modeling, the NIC has several other work streams going on in their macro-prudential working group that are looking at insurer investment activities, including financial disclosures, investment management agreements, and other items. And Pacific Life supports this holistic approach. So in conclusion, because I know those were pretty dense comments, 1, Pacific Life supports the NIC's current review of the RBC treatment of CLOs. 2, this review will continue to ensure that capital charges are appropriately calibrated for the risk of the asset class. And 3, once adopted, these risk charges will apply, regardless of ownership structure, to all U.S. insurers. Thank you for your time. I'm happy to answer any questions.
Thanks for having me today. Carl Anderson, good to see you as always. I'm Jim Hodges. As Representative Anderson has told you, I'm former governor of South Carolina about 20 years ago. Represent a group called the National Alliance of Life Companies, which is a group of small to mid-sized life insurers from all across the country. So we come with that perspective, the perspective of smaller life insurers, mid-sized life insurers who are sensitive to trying to preserve capital options. I do want to make a few general comments before getting into our feelings about these specific proposals. I think we're pretty well aligned with the NCOIL statement, and I'll elaborate a bit on that later. But I can't help but notice that some of this arises out of comments from members of Congress, senators, and House members who expressed some concern about private equity investment in life insurance. I can't help but be a bit amused by that, because if you look at the financial crisis back in 2008, 2009, life insurers did pretty darn well. State-regulated life insurers, banks, federally regulated, not so well. And our friends in Washington seem to want to scrutinize the level of scrutiny we provide to those entities that we regulate, life insurers. And I might say that in my 20-plus years around state regulators, state legislators have done a pretty darn good job of keeping insurers solvent. So I think when we receive inquiries and suggestions from Washington, we need to be careful about it. They don't understand insurance very well. They've shown that. They have their own struggles with regulation. They sure as hell have shown that. And we have done a good job at the state level. You all have done a good job. State regulators have done a good job. But there always seems to be this sensitivity when Washington says something that there's a fear that there'll be some imminent federal regulation if we don't jump. I don't think this is a case in which we jump, and I think you all have appropriately had a measured approach to this. From a small company perspective, I think I would say this. We feel as though every investor ought to be treated the same. I think you've got a good system in place, whether it's private equity or other sources of capital, everyone should be treated the same. There should not be a specific class to single out. For a lot of reasons. One is it makes no sense. There's no evidence that that's needed. But the second piece is when you are a smaller company, and we all know we want more small companies growing around the country. A number of you are from states that probably have a limited number of life companies. But we need to preserve options for capital. And the more unnecessary regulations we put into place that really aren't serving policyholders or companies, then the more we limit potential investment options to allow these small companies to invest in your communities and to grow their businesses. And that is a major concern of ours, that we preserve meaningful capital options, that we do nothing that is unnecessarily harms or scares away potential sources of capital for our companies. And a final comment here, there have been periods in the last decade where regulators, when there are companies that were in trouble, regulators have encouraged private equity enterprises to invest in insurance companies because they felt like that was capital that could be used to try to prop up and, yes, remain successful, these insurance companies. We don't want to get into that situation again where we create unnecessary obstacles to that investment, and we want to preserve those options that are available for companies to try to grow and prosper. And we believe that the framework is already in place in our state regulatory regime to properly evaluate these companies that are choosing to invest, to scrutinize the decisions that they make in terms of how they invest those dollars, and to protect policyholders. So those are the comments of the NALC. We feel strongly that the current system is working pretty well, and as you seem to have indicated in your statement, that finding a way in which any changes that we make are consistent for all of the entities or enterprises that invest in insurers makes the most sense. And like the other panelists, I'll be happy to answer any questions you might have. Thanks.
Well, thank you, Governor Hodges. It's good to see you. I have a question. I want you to clarify this for me and everybody else here. Do you mean all investors should be treated the same, or all insurers should be regardless of ownership structure?
I think all insurers, regardless of ownership structure, is probably the better way of saying that. But ultimately, if you are looking at putting capital into an insurance company and you've got an additional level of scrutiny that others don't have, it is going to discourage those who might put capital in. That's the point I was trying to make.
Thank you, sir. Thank you, sir. Do anyone have any questions? Well, Mr. Michael, Ms. Jennifer, and Governor Hodges, y'all did an excellent job today. And thank you, everyone. And that's just what, we bring from South Carolina, It's the nation state. If anyone has any question on this topic or thinks that NCOIL should continue to discuss it,
Can I ask one question?
Okay.
You
All
brought
right.
up a subject, and
Go ahead.
I wanted to know where you were going with him when you said, should all investors be treated equal? Why wouldn't we treat all investors equal?
Well, I wanted him to make his point clear. You know, I wanted him to clarify that. And actually, he was talking about the insurers.
Yep.
Yeah, that's why I wanted him to make sure, you know, that we got the right wording, because we want to make sure the minutes are right.
Sounds good. Thank you.
Mr. Chairman, may I ask a question?
Yes, sir.
Thank you. So Mr. Pacelli, close enough. What's AM Best's view on these investors that come in and participate in the insurers?
So the view is always driven by our methodology. And because the methodology is actually not reflecting the ownership structure, it's never really about that. And, you know, just like my co-panelists here have said, our view has been all along, it's not that you're a mutual or you're a private equity-owned firm. It's really about the activities that fall out of that. So, you know, just like we talked about with the risk-based capital model, our capital model that we use is very similar. If we see that unnecessary asset risk is being taken on, we're in a position to go and adjust our capital model and adjust the ratings outcome. And so that's the kind of thing that we're going to look for.
So if a private equity company came in and purchased or bought in, and they're trying to get a short-term gain, would you be able to recognize that and adjust their risk portfolio?
Yeah,
And then adjust your rating of the risk portfolio?
To be as clear as I possibly can, if you're looking at short-term gains in the life or annuity business, that is, we're going to meet with the management team. We're going to ask them questions that we could sniff that out. We are a data point. We are not the only data point, but certainly the fact that we meet with every management team as part of our rating process and as part of our methodology makes us relevant in this. And I can tell you that we would be able to without a doubt sniff that out. And the reason for that is because in our process, we need to see what kind of capital commitment is there. And by capital commitment, I don't just mean the capital that's put in today, but also the long-term capital commitment. In addition, because so many of us have years in insurance, it really, candidly, is hard to find a management team that comes to us that are people we haven't heard of before. It just comes with being in the business for 30 years. So,
And if I might ask Ms. Webb if she'd like to respond to anything you'd like to add to that?
No, I think that's did a good job.
Okay. Thank you.
Okay, with that being said, if you think that NCOIL should continue to discuss it, please reach out to the staff. That is Mr. Tom, Mr. Will, or myself as acting chair. Certainly want to thank the panelists, and I didn't do this the last time, but let's give the panelists a round of applause, and let's give the foreign panelists a round of applause.
thank you.
Mr. Tom, come on, talk to us.
So I just note this is not on the agenda for the NCOIL NAIC dialogue tomorrow. And I mean this totally respectfully. There was no NAIC representative at that table. And so to the extent that time's permitting tomorrow, under any other business, I just wonder if any of our NAIC colleagues are in the room, because I do just wonder if they'd have any feedback that they could tell us tomorrow at the dialogue about that. You know, is it something that they agree about, that regardless of ownership structure, the rules should be the same for everyone? And further, if they have any thoughts on that CLO issue. Thank you, Mr. Chairman.
Okay, thank you, Mr. Tom. Next, presentation on life insurance investment in social infrastructure and community development initiatives. Our next topic will be a presentation on life insurance investment in social infrastructure and community development initiatives. Joining us today is Mr. Keith, Policy Research Manager at the NAIC Center for Insurance Policy and Research, and Mr. Pat Reeder, Vice President and Deputy General Counsel at ACLI, and Mr. Doug Wheeler, New York Life Insurance. They are joining us, and we'll hold questions until the end. We're on a roll now, fellas, so go ahead.
Can you hear me? Is this on? Okay. So first of all, Mr. Chairman, I wanted to say that I spent the latter part of my teen years living in South Carolina and went to
Good.
Furman University. So
All right.
we've got that.
You're a Furman grad, eh?
Yeah, that's right.
Go, okay. Make sure you send something back for the alumni now.
Yeah. So I want to talk to you about some of the work that the Center for Insurance Policy and Research at the National Association of Insurance Commissioners has been doing around social infrastructure investment, which I think more in terms of community development types of investments. First, I want to thank you for the opportunity to speak to you about this research initiative. My name is Kelly Edmiston. I'm the Policy Research Manager at CIPR. I was a community development economist at the Federal Reserve Bank of Kansas City for many years, so I've been working in this space for a long time. And I'm very happy to see the insurance company or industry taking an interest, or I should say increased interest, in community development and social impact investing more generally. So when we're talking about social impact investments, we're kind of talking about the S and ESG. We're talking about investments that have an intentional, direct, and measurable positive, of course, effect on social outcomes. And for the insurance industry, the life insurance industry in particular, we're looking at investments that not only have a positive effect on social outcomes, but also that generate a competitive risk-adjusted return. In October of last year, the CIPR published a report, and it's on our website. It's called Can Insurance Company Investments Help Fill the Infrastructure Gap? And there we were talking about physical infrastructure, economic infrastructure. And our conclusion was, or is, that they can. We find that the financial performance of the infrastructure-backed investments were superior to other non-financial corporate investments across several domains, not every domain. They're long-lived assets. They help diversify portfolios. They can hedge against inflation. They generally yield competitive returns. And especially they have an appealing risk profile. So even within a single rating, if across all organizations rated AA, for example, the infrastructure-backed financial investments tend to have lower default rates, greater recovery upon default, and more stable ratings. But in this work, we did not consider social infrastructure, and we've since turned our attention to a similar question within social infrastructure. The question being whether the insurance industry can help fill the social infrastructure gap, specifically in community development space, and more specifically in the affordable housing space, not with their foundation investments, but with their general account or balance sheet investments. In terms of what is social infrastructure, it's in some sense not economic infrastructure, not physical infrastructure. It's infrastructure that improves the quality of life in a community. It could include many assets like hospitals and schools and community facilities, but our focus is largely on tangible community development investments or assets. And so these are assets that are most critical for low and moderate income communities, which typically are already struggling. And we're specifically talking about issues of affordable housing and community resilience to natural catastrophes. Those are particularly significant in this regard. At the CIPR, the Center for Insurance Policy and Research, we're working closely with the impact investing team at the Robert Wood Johnson Foundation in this endeavor. As researchers, we're agnostic, and I want to emphasize that for CIPR, it's a research effort. But the hope of RWJF is that, and the reason they came to us is that as insurers, as large institutional investors, can they infuse additional capital in this space and to help close the gap between community needs and the availability of social infrastructure and community assets. And based on CIPR's previous work in the physical and economic infrastructure space, which I just mentioned, RWJF approached us about similar work that can be done in the social infrastructure community development space. And so beginning this summer, we embarked on an exploratory phase of this research, basically to see if there's any there. The idea is to see if this effort to help close the social infrastructure or community development investment gap would be feasible for insurers. Can they make a positive social impact with their general account investments that generate an appropriate risk-adjusted return and meet the necessary regulatory requirements? And then can they do that at scale? This initial exploratory effort, which we're wrapping up currently, was to survey the landscape and to generate a list of questions to be addressed, which we would then approach with a deeper, more sophisticated research effort that we hope to do over the next couple of years. It was a learning effort, and through events and one-on-one meetings, we've engaged with insurance industry stakeholders, including the investment strategists, regulators, financial intermediaries, trade organizations, and also community development practitioners who are on the ground doing these types of things. I'll spend just a brief few minutes discussing what we found thus far and where we plan to go with the research. It shouldn't take me about a couple of minutes. Insurers have already undertaken impact investing efforts, so it's not totally new by any means. But the primary consideration of insurer investors, of course, is to fulfill their fiduciary responsibilities by enhancing the general account's risk-adjusted return. And social impact investors within the industry have generally found that they've generated competitive risk-adjusted returns with these investments. And moreover, like investments in the physical and economic infrastructure space, these social impact investments can bring increased diversity to existing portfolios. We've also discovered additional value added with these investments. Insurance, of course, is a risk-based business, and addressing social issues through their investments could potentially mitigate some types of underwriting risk even. There was a report out by Nuveen just yesterday, and they were discussing the fact that inequality is a systemic risk to their portfolio and to the entire financial system. And investing in companies and assets that provide solutions to those problems can mitigate those risks as well. Furthermore, most insurers want to be good corporate citizens, especially in their own backyards. And finally, insurers are major employers with vast numbers of clients, and stakeholders are increasingly demanding socially responsible investing. We've discovered a number of vehicles for these investments. That was a big part of the project. And no doubt there are more vehicles that we have yet to discover. And as the insurance industry is financially innovative, and no doubt there will be new structures developed along the way. Chief among these is, among the insurers that we found, is the low-income housing tax credit. I don't have time to delve deeply. It's a rather complex investment, but in general terms, it's the chief avenue for the federal government to subsidize the construction of affordable housing. They allocate a number of tax credits to each state, which in turn allocates tax credits to developers. And so developers can't use these tax credits because they're nonprofits. So what happens is investors put money into syndicators who purchase the credits. And so they can buy these tax credits generally for less than $1 and then get dollar-for-dollar tax reductions or tax credits with these instruments. One of the benefits of the syndication, the funds that they invest in, is that that other than monitoring the financial performance, and investors get regular detailed reports on the financial performance, These investments are largely hands-off for the investors. The fund, the syndication fund, is a limited partner, and they take responsibility for monitoring the investments for compliance. These investments are quite popular and have performed well financially for investors. Investors could directly invest equity in a development that's less usual or less common, but generally would be done through an intermediary. Just want to mention a couple more. Community Development Financial Institutions, or CDFIs, offer an opportunity or an avenue for making debt investments in affordable housing projects. The insured investor can invest directly in the CDFI, which then the CDFI does the due diligence to find and monitor affordable housing developments for which to issue the debt. And I might add that several of the CDFIs have been rated by major rating agencies, and the 11 that have been rated by S&P Global Ratings are investment grade, generally along the lines of an A-. And then municipal bonds is another avenue for investing. Private activity bonds, that is bonds that are issued by municipals, by states and local governments for private activities that have a community benefit. And potentially, in terms of scale, an insurer could buy an entire bond issue. And finally, there are other intriguing alternatives. Like there's a community development fund. It's a standard institutional investor-only mutual fund that uses its proceeds for social impact while generating a respectable return for its investors. Keep in mind, I've just scratched the surface of opportunities for investing with social impact. The CIPR looks forward to delving deeper with their research effort into this social impact investing space as an investment alternative for the insurance industry. There remain many questions to be addressed. Our intent is to better understand the risk-return profile of these investments, to uncover and analyze the various investment structures that are available for social impact investing and how they should be evaluated, and to understand the regulatory concerns that may arise and how they might be addressed. And so I thank you again for the opportunity to share the work of the CIPR at the NAIC in evaluating the feasibility of bringing social impact investing to scale in the insurance industry.
I'm not as smart as Kelly, so I'm going to do my best. My name is Pat Reeder. I'm Deputy General Counsel at the ACLI. I have the opportunity. The ACLI came to me 6 months ago, and they asked me to operationalize our affordable housing initiative. And I'm here today to talk to you about what we're doing. And I brought a friend because what I want to make sure we emphasize is that the initiative that we're working on is an initiative of the life insurance industry broadly, how we can bring our scope and scale and our investing expertise into the affordable housing area. But we are not alone. It isn't just broadly. Individual companies are putting great resources and great deal of intellectual capital into this space, and we have an example here today. So if I can sort of give the history of what we're doing and why we're doing it. The life insurance industry has been engaged in our communities for 150, 175 years. It's one of the cornerstones of what the life insurance industry does, and you all know that. You've been engaged in this in your professions, and you understand what the life insurance industry does. And a lot of the work in affordable housing and community development has been done by their foundations, right? They have a lot of charitable arms, and they put a lot of significant amount of money and work into affordable housing through their foundations, and through just their broad engagement with the communities where their employees are and that sort of thing. But if you go to the summer of 2020. The summer of 2020, the death of George Floyd, the insurance industry got together, and many organizations, many industries got together and said, we need to do something. They were motivated. They said, and our CEOs were very wise. The ACLI, we had a statement. We spoke into this. It's important that you speak into these issues, that you have your voice be heard. But it wasn't our CEOs were wise. They said, that's not enough. We don't want to just talk about this. We want to do something. We want to do something that is sustainable, that is meaningful, that is going to actually make an impact. And from that, the CEOs instructed us to develop an initiative that's called our Economic Empowerment and Racial Equity Initiative. It's got 4 pillars. One of the pillars is closing the racial wealth gap. And what the idea is that the insurance industry is really good at certain things. And our CEOs told us very clearly, don't get out over your skis. Let's not try to do things that we're not good at. While there are important social issues that are out there and we can make a positive impact on our society and our communities, let's not try to do things that we're not good at. So we said, what are we really good at? The life insurance industry is really good at protecting people's financial futures. The life insurance industry is really good at long-term investing. And so we'd look at those things and we said, how do we use those things that we can close the racial wealth gap? And that gave rise to the development of what our subsidiary of ACLI, our initiative called 360 Community Capital. And 360 Community Capital is a nonprofit organization that is being established and set up by ACLI member companies. In April of this year, the ACLI Board of Directors voted unanimously, and they said, go operationalize this. This is important, make it happen. And from that, 42 of our member companies not only voted to do this, they put money up to get this operation started. So what are we trying to do? We're going to start with the premise that we want to find ways to take, and Kelly was talking about it, find ways to take insurance companies' general account dollars and put those general account dollars to work in affordable housing. Affordable housing is so foundational to closing the racial wealth gap, we thought we would start there. It doesn't end there, but we need to start somewhere. It's the idea of boiling the ocean or whatever phrase that you like. I always talk internally about start by starting. And so that's what we're going to do. We're going to start with affordable housing because that's so foundational. And we're going to use general account funds, and you all know this. You know this with the work that you do. We're going to start with debt. Life insurers love debt. We're going to start long term. You know, the life insurance industry, we love long term illiquid debt. We're really good at that. We've been doing that a long time. We're going to need these investments to be investment grade, right? You heard even the panel before us, and Kelly was mentioning, right? For general account dollars, the general account investing for life insurers is to be able to pay claims when due. That's the purpose of what those investments are. But we want to find affordable housing investments that do the good that Kelly's talking about, but also meet our needs to our policyholders and our members. And so that's going to be investment grade. And it's got to be market rate returns. Again, we have this obligation. This is, again, our companies do tons of work in the foundation space, in the charitable space, but this is market rate. And we believe there's a market out there. In the affordable housing, many of you know this with what you do. Affordable housing is a term of art in the community development space. Affordable housing is usually is a measure of area median income. So it's sort of what is the income of the people in a certain community, average median income. Affordable housing has different ranges, but affordable housing is usually defined as 60 to 80% of average median income. But there's another piece of affordable housing that's really important that's going to be a part of this initiative, which is what's often called workforce housing. You'll hear that as workforce housing. And workforce housing is typically defined as 80 to 120% of average median income. Think of your shopkeepers, your teachers. And so if we can find ways that the life insurance industry can work on what they call naturally occurring affordable housing, or NOAA, which we think of rehab, so houses and apartment complexes and condominiums that are rehabbed for the purpose of affordable housing, where the rents will be set in such a way that they will be able to be maintained as affordable housing units. So affordable housing, but also workforce housing, which we think that's a way that we can do that. We think this is going to be hard. The community, the CDFI world, if you will, the borrow world, the financing network that Kelly mentioned, they've been doing this a long time, and there's an ecosystem out there. There's a lot of the low-income tax credits. There are banks with community development investing requirements. There are cities and municipalities that are putting money into this. There are And all of that's very important. So we've got to find out how do we use these insurance company general account funds? How do we create those opportunities? And so it's going to take some time. It's going to be hard. We'll be working with the NAIC, because you heard about the RBC and the charges. Again, life insurers are investing in their general accounts so that they can pay claims, so that they can make good on their promises. What we're trying to do here is to find a way that we can do those investments where we're making good on our promises, but we're also going to be investing into our communities and affordable housing. One last thing, I'm going to talk about I want Doug to talk about a very specific example of what New York Life is doing. But we get asked a lot, why affordable housing, and is that all you're going to do? You know, what if, one of our CEOs said, well, what if we build these great affordable housing units and it's in a food desert? What about that? How is that? And we realize, as I said before, we need to start by starting, and we think affordable housing is foundational. And we think it'll do two things. One, it's going to attract other money. If you start building affordable housing units that are in this space, you're going to be able to get other areas that may come in, and they may take care of the medical services. They may invest in the transportation, or they may invest in the fresh fruits and vegetables. And the second thing is we think that once we get started, we're going to be able to create some momentum. That's our goal. To me, that's our success case, that we build momentum. That more people come in and say, wait a minute, we don't just need to do affordable housing. We want to work on the schools. We want to work on the grocery stores. We want to find ways to do this, again, with general account dollars, because we think that can move the needle. And again, we have an example of what New York Life has done. New York Life has not just been a participant and an intellectual capital driver of what the life insurance industry has been doing. They're doing something specifically for themselves, too.
Thanks, Pat, and thanks for having me. Doug Wheeler, Senior Vice President, Office of Government Affairs at New York Life. And as Pat mentioned, in addition to being a very proud partner of the 360 Community Capital Project, New York Life, in the spring of 2021, we announced $1 billion impact investing initiative. And primarily so far, and we've deployed pretty much the $1 billion, but a lot of it's been, as Kelly and Pat have mentioned, mostly in the tax credit, affordable housing tax credit area, because that's the low-hanging fruit. And the initiative was really focused in three areas: affordable housing, small business investment, as well as community development. And again, so far, a lot of the focus has been around affordable housing. And we've obviously seen some challenges, and that's one of the things that Pat alluded to in terms of our working with the NEIC to make sure, because as both Kelly and Pat have mentioned, we're using balance sheet dollars. We have to get returns, and we have to make sure the capital charges and all those accounting issues and some of these other issues that the NEIC get addressed. And I have to tell you, we are completely mission aligned with the NEIC. We have had meetings with leadership and other commissioners. We had a powwow at a recent NEIC meeting, and like 20 different commissioners showed up. It was literally, we were bringing in chairs from the outside because there was so much interest. Because when we do these investments, first of all, it's all 50 states. It's in all of your states, all of your communities, and this is about, again, bridging the wealth gap, serving undercapitalized and underserved communities. And when you provide affordable housing, when you invest in small businesses, you're creating jobs. And as Pat just mentioned, that leads to the building of schools and hospitals. And for us, New York Life has 12,000 agents across the country. This is now customers, right? These are people that now actually have jobs and want to build wealth and build these communities. And so for us, it's an opportunity to sell our products, provide financial security, and again, bridging that wealth gap. And it's a win-win for everybody. And so NEIC is completely aligned with us. They're working with us, and certainly we appreciate their efforts. We participate in part of the CIPR work. And again, this is something that is a win-win for everybody, and it's obviously a win-win in your communities as well. Again, that's pretty much it. Happy to answer questions with the rest of the panels.
Thank you, gentlemen, for your presentation. Let's give them a round of applause. Senator has a question.
Yes, sir. Thank you, Mr. Chairman. I listened to all three of you gentlemen. I think that the intent of your mission there is to make the insurance industry woke. Is that accurate?
It's actually not how I would describe it.
Well, the gentleman on the left, I'm sorry, I can't see your last name, Kelly, but I don't want to call you by your first name.
Sorry, you can call me Don.
You mentioned the banking industry and ESG. ESG is just woke critical theory infused into the banking system. And I listened to you mostly, sir. You use the most code words of critical theory of all three of the gentlemen here. But to me, that's what it sounds to me like what you're doing. Am I incorrect there?
I think so, and the reason is at CIPR, which is the research center in NEIC, we're agnostic on this.
I don't think you're agnostic, sir. I listened to you.
We are agnostic. The question came to us, is this something that the insurance industry can do? And so we're asking the question, can they generate reasonable or adequate or whatever necessary risk-adjusted return and do the social impact investment at the same time? And is that going to meet regulatory and statutory accounting standards?
That's all woke Marxism is what you.
We're completely agnostic.
It's not agnostic, sir. I've read enough on it. I won't belabor it.
We're researchers. It's either we're going to find that it is, or we're going to find that it isn't. I don't care. That's not my job. I'm a researcher. It's up to the insurers to decide what they want.
You're a threat to the free markets and the free markets of the insurance agents. Thank you, Mr. Chairman.
All right. Okay, thank you very much. Representative Bennett, and then we have Senator from New Hampshire, right?
Yes, sir.
Okay, Representative Bennett, then
Thank you, Mr. Chairman. And here to think we were having such a nice day. I've heard this a lot from my colleagues back home in Oklahoma, but would you not agree that the efforts that you guys are taking on also has the side effect of eventually creating a larger base of people who are able to afford life insurance products and other things like that, that really these other societal benefits, as bad as some people think they are, also create a wealthier, healthier environment for our economy? Do you agree with that?
Yes, sir. That is one of the purposes of what we're trying to do.
All right, Senator from New Hampshire.
Thank you. I'm going to try to do something in between in light of the hospitality of our wonderful South Carolina senator. I look at things more of a financial aspect. And so for me, the district I represent, Doug, we were talking last night, you know where I represent, southern New Hampshire. It's middle America. So when my people hear you talk, they're not thinking woke or racism. They're thinking, you're going to cost our community because you're going to put in workforce or affordable housing in my 12 little towns who can't afford the tax increases. You're going to result in tax breaks to these workforce housing. You're going to add students to our schools, which are already overburdened. The average family in my little district is paying about $10,000 to $15,000 for little Cape houses, and they can't afford taking on additional responsibilities. We're all in favor in New Hampshire of our cities want it, our more liberal towns want it, and we're all for it. If they want to take it, that's great. But they're trying to now hoist this onto my small communities who can't afford the burden to our educational system. We're averaging around $21,000 per student. So if you're putting in workforce housing where they're not either going to get a 10-year tax break, they're going to pay less money, they're not putting into the educational system, and you're putting a burden on an overstressed property tax, in my case. Just a comment. If you had a comment.
I'll just respond that I think that the idea of what this is trying to do, and the idea is that you're trying to enhance the economy all over, right? Is what you're trying to do, because if you think in the workforce housing space, you're thinking of the people that work in the stores that the members in your community shop at. Those are the people that work there. The teachers that you're worried about that are overburdened, overstressed, and that's certainly real all across the country. But if they have more stable if they're working one job instead of three, because they have a predictable rent as opposed to a rent that they don't know when it's going to go up. Those are the kinds of things that we think that we're going to have what I will call knock-on effects into the community. And so I recognize and appreciate your concern, but we think that the results of what could be done by these investments can have great effects in the community.
Thank you.
All right, we'll now hear from the senator from Michigan.
Thank you very much. Gentlemen, I appreciate your presentation. Here's my struggle. Where do you balance the fiduciary responsibility of actually looking forward and investing in known returns on investment to what you believe will have an effect on community planning, which may or may not actually meet itself out successfully? There's no doubt that this is a higher risk because you're looking longer term, believing that you can affect a change that may or may not happen. Where's the fiduciary responsibility balance there?
Thank you. That's a great question, and I'm really glad you asked it. And because
Microphone?
I'm sorry, I leaned away. Sorry about that. So thank you. That's a great question, and I really am glad you asked that, because one of the key pieces of this initiative, this isn't donations, right? These aren't just donations. Our member companies do that. These are investments, and those investments need to be investment grade, and they need to have a market return. That isn't easy, right? You heard Doug say that they've deployed a lot of it. There isn't. Again, because it's not because needs to be investment grade, meaning that it is risk similar to other risks that are out there, similar to corporate bonds, similar to, you heard the ABBB sort of reference in the prior panel. That's the kind of investments that this initiative is looking at. For the very reason that you're talking about, there is this obligation, and it's you talked about the fiduciary obligation. Again, these members are making investments so they can pay their claims. If they can do social good, that's great, but they're making investments to be able to pay their claims. And so that doesn't change with these investments. What we're trying to do that hasn't been done before is to find investments that meet that obligation that you're concerned about, that are investment grade, that provide market returns so that companies can make good on their promises and do the social good. It is not an or, it's an and. And it's a good question, and that really is an important guidance that we have and our members have given us, is that we find the and. It is not as easy to do, but we want to work to find that.
If I may continue? So you're saying literally all things being equal, or are you saying there's a cost that we're willing to take?
Again, it is all things being equal. These are going to be investment grade and market return. That's what our members have said. And we've done our due diligence, and we've been doing the work to say those opportunities are out there. They're sometimes harder to find, and we're going to do that work because we think that's work worth doing. But again, it is an and, it is not an or.
And just a great question, and we have an impact investing team within our investment shop at New York Life. It's investment first.
Doug, Mike?
Sorry, it's investment first. So it's got to meet the requirements and criteria for our investments. As Pat just mentioned, returns, it's got to meet our internal investment criteria. The social good is the check, right? That's the added plus to the investment. And obviously, we'd like to it's nice to have, and we want to do more of it, but it's investment grade first. It has to generate returns because, as we've said over and over and over again, these are balance sheet dollars to pay claims down the road at some point in time. But we look at certain investments, and we use these CDFIs, these community development financial institutions. Those are the folks in these communities. Those are the ones who help build the deals, and those are the ones that know where the needs are. And they come to us, and they say, okay, here's the proposal, and we have to make the economics work. That's the first thing. And obviously, if it goes to fruition and there's a social good, again, that's an extra check. We want to do a lot of it. Our industry wants to do a lot of it. But it's investment first, because that's our fiduciary responsibility.
I might note also that they have to meet regulatory muster, right? So there's no interest in reducing regulatory burdens to make these
Excuse me, Kelly, your microphone's not on. People in the back can't hear.
Okay, sorry about that. The investments have to meet the standard regulatory requirements and statutory accounting requirements that are in place now. No one's talking about changing the regulatory requirements for these types of investments.
Sorry, just one more comment and I'll let it go.
Okay,
I think the
go ahead.
concerns that, that some of us have are that you're adding an extra element into the algorithm for the consideration for what to do with the investment. The algorithm has a lot of unknown associated with it. We've seen in the investment markets that are ongoing right now, there are some very major issues associated with adding something in that is purely fiduciary as you're moving forward. So I have significant concerns with someone's idea of what is a social good as opposed to strict dollar responses. And I understand the arguments for both sides, but I have extraordinary concerns when we're not just simply looking at the primary fiduciary responsibility and instead adding more in. And while I understand that we're speaking within our current regulatory system, there's a lot of flex in that, in the regulation, and you look at what's the best and you invest in the best. And right now we're saying, well, we're going to redefine what the best looks like. And that, I think, and I apologize if I'm speaking out of turn, but I think that's what the concern that a lot of us have.
Thank you, everyone. We look forward to learning more about this initiative as you continue to inform us as we move forward. Are there any other business? I just want you all to, relax a little bit, breathe in, breathe out. My vice chair, Representative Walter, has been sitting here, and we will flip seat. He's the chair for Articles of Organization and Bylaws Revision Committee, and there's only one or two things that need to be said. I know everybody want to go to dinner, but if you would sit tight, we're going to flip seats. We're not going to break. We're going to flip seats. Oh, we got a break? Okay. All right, okay. We're going to break for 5 minutes, and then we'll flip seats.